Welcome to the deep dive. $1.47. That's where shares of Advantage Solutions Inc., ticker ADV, were sitting as of May 9th, 2025.
Pretty low.
Yeah, exactly. Now, consider this. Analysts actually see a potential jump, quite a significant one, with price targets stretching from, $2.60 all the way up to $4.50.
That's a huge range.
It is. So the question we're tackling today is this. Is Advantage Solutions a deep value play just waiting to be discovered? Or, could it be a classic value trap?
That's the core question, isn't it? Right at the heart of value investing. And it's exactly what we're digging into today.
Okay.
Our source material, it's a comprehensive research report dated May 10th, 2025. We're going to unpack Advantage Solutions, that's NASDAQ, ADV, really through a value lens.
Looking at the business model.
Yeah, the business model, the leadership, their financial standing, and even, how those U.S. tariffs from 2025 might play into their future.
Right, it's a test.
And just to be clear for everyone listening, all the data we're discussing is current as of May 10th, 2025, unless, we state otherwise. Got it. So our mission for this deep dive, it's pretty straightforward. We want to figure out if Advantage Solutions at this current valuation offers a compelling long-term investment opportunity for you, the listener. We're going to try and cut through the noise, focus on understanding their core operations, and identify the really crucial elements that will likely shape their future.
Makes sense.
So in this first half, we'll be getting to grips with the business itself, taking a close look at the leadership team, and really digging into the company's financial health.
Precisely. Let's kick off with understanding the business. So Advantage Solutions, they've been around a while, since 1987, headquartered in Irvine, California.
Okay.
They went public fairly recently, 2020, via a SPAC merger. Their role essentially is as a key link, an intermediary.
Right, between the consumer goods manufacturers, the CPG companies.
Exactly. And the retailers who sell those goods. Their mission, as they state it, is to help clients sell more while spending less.
That sounds good. It does. They talk about a people-first, purpose-driven, performance-focused approach. Now, a really significant recent event was a financial restructuring, early 2024.
That was the big debt reduction, wasn't it?
That's the one. Reduced their debt by about $1 billion. That's huge. It kind of highlights their evolution, from maybe a traditional food broker to this broader solutions provider. That adaptability is key.
Sure, in this market.
And being that intermediary, well, they need strong suppliers and healthy retailers to thrive. That $1 billion debt cut, though, that could genuinely be a turning point for a company trying to turn itself around.
Absolutely. So how does this intermediary actually, work? How does the model function?
Well, their business model, it centers on providing outsourced sales, experiential marketing, and other marketing solutions.
Outsourced? Okay.
Yeah, they've got a large field workforce. They use various tech platforms, and they lean heavily on data analysis.
Right. Data's everywhere now.
It is. Revenue comes from service fees, charged to both the CPG brands and the retailers. And this operates at a really massive scale. We're talking tens of thousands of retail locations.
Wow.
And it's not just about being there. They're constantly gathering data, which they say gives their clients valuable, actionable insights.
So what drives their economics? Client spending, I assume.
Definitely client spending. Also overall trends in retail sales. That includes e-commerce, of course. And given that large workforce, labor costs are a pretty significant factor for them.
Okay, that makes sense. Relying on client spending means they're probably somewhat sensitive to economic cycles, right? If CPGs or retailers feel the pinch.
Exactly. Budgets for outsourced services could get squeezed. But that emphasis on data collection, that's a real potential asset.
How so?
Well, in today's market, being able to offer data-backed insights, that's a serious differentiator. It adds real value for their clients. And with labor being a big cost, well, efficiency in their field operations and using tech smartly to manage that workforce, that's going to be crucial for their profitability.
Okay. Now let's break down the actual services they offer. You mentioned 3 main segments.
That's right. First up is branded services. Think of this like an extension of the CPG company's own sales and marketing teams.
Okay, so like handling their sales teams.
Yeah, things like managing key headquarter sales relationships, boots on the ground, retail merchandising, running marketing agency operations, even handling business process outsourcing across different sales channels, mainly US and Canada. The goal is strengthening the brand's presence in the market.
Okay, but there was something notable here in FY24, right?
Yes, that's important. In fiscal year 2024, they made a point of strategically parting ways with some clients. They actually called it an intentional client resignation.
Intentional resignation. That sounds deliberate.
It does. And they've also been doing what they call right-sizing efforts within this branded services segment.
So that intentional resignation, I mean, it really raises a question, doesn't it? Was this about dropping less profitable clients, which could be smart, or does it maybe hint at a bigger issue with keeping clients happy in their core business?
That is the critical question. Letting go of unprofitable business can be a good long-term move strategically, but it hits revenue straight away.
Right.
And right-sizing suggests they're trying to realign resources, maybe trim costs. But we really need to understand the why behind both these moves to get a true picture of how healthy that branded services segment really is.
Okay. What's the second segment?
Second is experiential services. This is all about creating, engaging sampling experiences. Think in-store demos, online sampling campaigns.
Things designed to build loyalty.
Exactly. Build loyalty and ultimately drive sales. And interestingly, this segment actually showed some positive momentum in FY 2024. Revenue grew, and they reported healthy profits.
Why was that?
Seems it was driven mainly by an increase in the number of events they ran. So it suggests that even while other areas faced headwinds, the demand for creating these direct consumer experiences, it's still strong.
That's a positive sign then, the profit margin there.
Definitely. It provides a bit of a contrast to the struggles in branded services, showing there's still an appetite from brands for this kind of interactive connection with consumers.
Okay, and the third segment.
Finally, there's retailer services. Here, Advantage offers solutions directly to the retailers.
So not the CPG brands, but the stores themselves.
Correct. This includes things like developing private brand strategies, that's their Damon business, providing merchandising support, offering retail media solutions, even optimizing shelf layouts.
And how did this segment do in FY24?
It saw a slight dip in revenue. They put this down to retailers facing their own cost pressures and maybe reducing the scope of services they were buying.
So retailers cutting back a bit.
Seems like it. But, like the experiential segment, retailer services also managed to maintain healthy profitability.
So even with lower revenue, the core service seems valued.
It appears so. It speaks perhaps to the essential nature of some of those services, especially things like private label development, which is a growing area, and basic merchandising.
Okay, let's try and put some numbers on this. FY 2024 total revenue was, what was it?
$3,566.3 million, about $3.5 billion.
Right. And as we said, branded services revenue decreased, but experiential and retailer services delivered healthy profits.
Correct. If you look back a bit to FY 2023, for context, the bulk of revenue, maybe 67%, came from those sales services, primarily branded. Marketing services, including experiential, were about 33%.
And drilling down further within that.
Within FY23, merchandising was roughly 60% of the pie, marketing around 30%, and other services about 10%. Geographically, North America is really dominant for them.
How much?
Around 80% of revenue in FY 2023. Also worth noting, the deconsolidation of their European joint venture in Q4 2023, that impacted the FY20 core revenue comparison.
Okay. And that intentional client resignation keeps coming up. Seems like a key factor affecting that core branded services revenue stream.
I think you have to keep emphasizing that. It's not just the immediate lost revenue. It could signal shifts in what clients want, or maybe tougher competition in that space. And being so heavily reliant on North America ties their performance very closely to the economy here.
Makes sense. Let's move on then. Chapter 2, Management Evaluation. Who's actually running the show at Advantage Solutions?
Okay, leadership. The CEO is Dave Peacock. He came on board in January 2023.
Relatively new then.
Yeah, but he brings a lot of experience over 30 years in CPG and retail, places like Schnucks, Anheuser-Busch, Continental Grain.
Okay, relevant background.
Definitely. And he has a decent ownership stake, somewhere between 0.66% and 0.7%, and he's actually increased his holdings recently.
That's often seen as a good sign. Who's the CFO?
That's Christopher Growe. He joined before May 2025, comes with over 25 years in finance and investment, notably from Stifel Financial.
And he's been buying shares too.
Yes, also been buying shares, owned around 305,000 as of March 2025. Then there's Ian General, appointed COO of Branded Services just in March 2025. Another veteran, 30-plus year CPG experience, Henkel, Treehouse, Newell, Kraft Heinz.
So bringing in experience for that key segment.
Seems like it. They also have specific COOs for experiential and retailer services, plus the usual C-suite roles, CLO, CCO, CHRO.
What about tenure overall?
The average tenure for this top team is actually quite short, around 2.2 years, which really highlights, the newness of the leadership that's focused on this turnaround effort.
And those recent share purchases by the CEO and CFO, as you said, they do suggest some internal belief in the company's direction.
I think so. Peacock's extensive background in both CPG and retail seems like a strong asset, given where Advantage sits in the value chain. Growe's financial expertise is obviously critical right now during this restructuring, and bringing in a new COO for branded services shows they're focusing on the challenges there. Insider buying, especially from the top, usually aligns management with shareholders, is generally positive.
So what's the overall strategic direction they're articulating?
Their strategy really revolves around these transformation initiatives. The aim is better operational efficiency, improving services, and accelerating growth. CEO Peacock has emphasized bringing speed, precision, and insight to clients.
Okay, buzzwords, but what are the priorities?
Key priorities seem to be streamlining operations and cost discipline makes sense. That right-sizing and portfolio simplification we saw with branded services and the European JV exit. Investing in technology and data capabilities, things like new ERP, CRM systems, even using AI for staffing.
Interesting.
And finally, a disciplined approach to capital allocation. That means focusing on debt reduction and share buybacks.
And their outlook for 2025?
They're forecasting pretty modest growth, low single digits for both revenue and adjusted EBITDA. They expect adjusted unlevered free cash flow conversion over 50% of adjusted EBITDA. Net interest expense projected between $140 and $150 million, and CapEx around $65–75 million.
But these transformations, they don't come without risks, right? We saw impacts in FY24 impairments, reorganization costs.
Absolutely. There are inherent execution risks. And we saw the intentional client resignation. Hitting those targets without more disruption or losing more clients, that's going to be the critical challenge. The modest 2025 outlook reflects that they're still very much in the thick of it.
Right. The ability to get those efficiencies without hurting client relationships seems key.
Paramount. And that focus on tech and data, while crucial long-term, also requires investment and successful implementation.
Let's talk about how they're using their capital. The allocation strategy seems heavily shifted towards fixing the balance sheet.
It does. That early 2024 recapitalization, cutting debt by about $1 billion, was a major step. They followed up with $158 million in voluntary debt repurchases in FY 2024.
And they improved their loan terms, too.
Yeah, they managed to reduce the interest rate margin on their term loan. The stated goal is getting net leverage below 3.5 times adjusted EBITDA.
What about returning cash to shareholders?
They've been doing share repurchases. About $34 million in FY 2024 and another slug in early 2024. M&A seems less of a priority now, maybe more focused on divesting non-core assets. Large deals look unlikely near term, and they're not currently paying dividends.
So really focusing on deleveraging and maybe buybacks if things improve?
Exactly. It's a pretty typical playbook for a company in turnaround mode with significant debt. Lowering that debt burden gives them more flexibility and cuts interest costs. Buybacks at these low prices could be very accretive, but only if the turnaround actually works.
But the flip side is being too conservative could starve growth investments.
That's always the balancing act, yes.
Okay, what about corporate governance? How is the company overseen?
They state a commitment to high standards. You've got the board overseeing management, a fiduciary duty to shareholders. They publish their code of ethics, governance guidelines, committee charters. There's an anonymous ethics hotline.
Standard.
Pretty standard. They have an active investor relations program. Earnings calls, releases, website with filings, presentations. The shareholder structure, though, is quite noteworthy.
How so?
Leonard Green & Partners, the private equity firm, holds a majority stake, around 56%.
Wow, that's significant control.
It is. It gives them substantial influence over strategy, board seats, executive pay, major decisions. That recent restructuring we talked about, you can bet they had significant backing from Leonard Green.
So PE involvement is a major factor here.
Absolutely. PE firms brings focus, often drive performance, but their investment horizon and exit strategy might not always align perfectly with, say, a long-term minority shareholder. It's definitely something for potential investors to consider.
Right. And finally, for this section, let's revisit insider ownership and trading. We mentioned the CEO and CFO buying.
Yes. CEO Peacock had that significant non-open market acquisition in April 2025, plus earlier open market buys. CFO Growe also had a large non-open market purchase in April 25, on top of earlier open market buys.
And he sell.
We did see the COO of Experiential Services sell some shares, maybe late 2024 or early 2025. But the independent chairman actually made a significant purchase.
So what's the net picture over the last year or so?
Over the 12 months leading up to May 2025, There were more insider buy transactions than sells. Net positive, over 1.26 million shares bought by insiders.
And more recently.
Looking just at the 3 months prior, the net buying activity was even stronger, over 2.11 million shares bought, net.
Okay, so while you have to distinguish between compensation shares and real conviction buys.
Right. But those open market purchases by the CEO and CFO, they generally send a positive signal. It suggests confidence from the people who should know the business best. Of course, what the majority PE owner does or doesn't do also sends signals to the market.
Okay, that covers management. Let's dive into Chapter 3, financial health. We need to really get into the numbers now.
Agreed. Looking historically, say the last 5 fiscal years, 2020 to 2024, the financial picture is, well, a bit mixed. Revenue dipped in 2020, likely COVID impact, then recovered and grew through 2023. But then it declined again in 2024, partly due to that European JV deconsolidation we mentioned.
And profitability.
Net income has been vital. They actually reported losses in 2022 and again in 2024, largely due to big impairment charges and restructuring costs.
What about adjusted EBITDA? That often smooths things out.
It does look more stable, showing modest growth over the period, but operating cash flow has also fluctuated quite a bit. This history really underscores that they've been navigating a major restructuring and a tough market.
Okay, let's zoom in on the most recent full year, FY 2024. Revenue was $3,566.3 million, down 8.6% reported.
But they did achieve 1.0% organic revenue growth for the full year. Though worth noting, organic revenue actually declined by 2.4% in the fourth quarter alone.
Okay, so maybe slowing momentum there. What about the bottom line?
It was rough. A significant operating loss of $295.0 million. That's a huge swing from a $46.6 million operating income in FY23, primarily driven by goodwill impairments and those restructuring costs.
And net loss?
$378.4 million net loss. Again, much worse than the $81.2 million loss in FY23.
Ouch. Any bright spots?
Well, adjusted EBITDA was $356.0 million, which was actually up slightly, 1.1%, and their adjusted EBITDA margin improved to 10.0% from 9.0% the year before.
Okay, so adjusted metrics looking a bit better. What about the balance sheet basics? Cash, debt.
End of year, cash around $205 million. Total debt about $1,721 million. Total equity, $748.7 million.
And cash flow?
Operating cash flow is $93.1 million. CapEx was roughly $55 million. Now, this is where it gets interesting with adjustments.
How so?
The company calculates something called adjusted unlevered free cash flow. For FY24, they report about $335 million. That's a very high, 89% of their adjusted EBITDA.
Okay, but what about standard free cash flow, OCF minus CapEx?
Using that standard definition, you get a much, much lower figure, just $38.1 million.
Wow, that's a massive difference.
It is. A gap of roughly $734 million between their GAAP net loss and their adjusted EBITDA. It really requires a deep dive into those adjustments to understand what's being added back and how sustainable that adjusted profitability really is.
That discrepancy is definitely a red flag, or at least something demanding scrutiny. You need to know if those add-backs are truly one-off costs or if they're masking ongoing issues.
Exactly. While adjusted metrics are common during turnarounds, the sheer size of the adjustments here needs careful examination. That company-defined free cash flow metric, while maybe useful internally, needs to be squared with standard measures for a clearer picture of actual cash generation.
Let's talk profitability margins then. Gross margin in FY 2024.
Looks like it was around 14.1% to 14.2%. Now, some data from the prior year, FY23, suggested a much higher gross margin, possibly around 28.3%. So this potential sharp decline is quite concerning.
A potential halving of gross margin. That sounds fundamental.
It could be. Needs more investigation. Their GAAP operating profit margin was negative 8.27%, a steep drop from positive 1.2% in FY23. That means core operations were unprofitable before interest and taxes.
And GAAP net margin?
Also deeply negative, negative 10.61%, down from negative 2.1% in FY23. As we noted, the adjusted EBITDA margin did improve to 10.0%.
So these collapsing GAAP margins are worrying. If gross margin really fell that much, it could point to serious issues with costs or pricing power. The huge gap between GAAP and adjusted figures just hammers home the impact of those special items.
Absolutely. It underscores the urgent need for their transformation efforts to actually translate into real, sustainable improvements in core profitability, not just adjusted metrics.
Okay, what about return on investment? Return on invested capital, ROIC.
For FY 2024, calculating it is tricky with the loss, but it seems to be negative.
Okay.
Somewhere between maybe -8.5% -5% and -9.2%, depending on tax assumptions. Mark Chameleon had it around -7.3%.
And historically, return on equity.
ROE has also been significantly negative recently, and forecasts suggest only modest future ROE, implying current ROIC is very low or negative.
And negative ROIC means?
It means the company isn't generating enough return on the capital invested in the business. It's actually destroying value because the returns don't cover the cost of that capital. High debt makes this worse.
So the turnaround has to deliver significant profit improvement just to get ROE positive and above their cost of capital.
Precisely. That's the benchmark for creating actual value. They need to significantly improve NOPAT net operating profit after tax to get there.
Let's look at the balance sheet strength, or lack thereof, as of year-end 2024. Debt to equity.
High, 2.3x. Net debt was around $1,516 million. That gives a net leverage ratio of 4.0 times adjusted EBITDA.
Which is above their target, right?
Yes, their target is below 3.5x. On the liquidity side, their current ratio looked okay at 1.98, suggesting they can cover short-term obligations. Quick ratio also seemed reasonably strong, maybe 1.8 to 2.0.
But what about tangible book value?
That's a concern. Tangible book value per share was negative $3.30.
Negative. So high proportion of goodwill compared to tangible assets.
Exactly. That high leverage amplifies financial risk, especially given the recent unprofitability. And the negative tangible book value highlights the risk of potential future goodwill impairments if acquisitions don't pan out as expected.
Okay, finally on financials. Cash flow generation and working capital, OCF in FY24 was modest.
$93.1 million. After CapEx of about $55 million, standard free cash flow was only $38.1 million. Again, way lower than their adjusted figure.
Did they manage working capital well?
They showed some improvement there. Days sales outstanding, DSO, decreased to 61 days in 2024, which helped generate some cash, and the current ratio indicates positive working capital overall.
But that $93 million in OCF seems tight against future obligations.
It does seem thin when you consider the projected interest expense for FY25 is $150 million, and planned CapEx is $65-75 million.
So not much internally generated cash for debt reduction or growth
Without asset sales, maybe equity raises, or really substantial benefits kicking in from the restructuring efforts, their ability to generate robust, sustainable, unadjusted free cash flow is absolutely critical going forward.
Okay, that wraps up a pretty detailed look at the financials. That concludes the first half of our deep dive into Advantage Solutions. We've covered the business, the management, and the often challenging financial picture.
Indeed. When we come back, we'll shift focus to how the market views the company, the ownership structure, key risks, including those tariffs, and try to tie it all together.
That sounds good. We'll look at market sentiment, ownership, risks, and try to answer that initial question. Deep value or value trap? Stay with us.
We'll be right back after a short break to explore the market's take on Advantage Solutions.
Welcome back to the deep dive. We're into the second half of our analysis of Advantage Solutions. Let's jump straight into Chapter 4, Market Sentiment. How is the market actually viewing this company right now?
Okay, market view. As of May 10th, 2025, share price $1.47. That gives a market cap of roughly $475 million.
Tiny for a company with billions in revenue.
It is. Price to earnings, PE, is negative, of course, because of the losses. Price to sales, PS, is extremely low at 0.13x.
0.13 times sales. Wow.
Yeah. Enterprise value, EV, which includes debt, is around $1.99 billion. That puts their EV to adjusted EBITDA multiple at about 5.59x, and price to book PB is 0.64x, with book value per share around $2.32.
So those very low PS and PB ratios, they scream market skepticism, right? Discounting assets, discounting revenue.
Absolutely. The market seems to be sending a very clear message of low confidence in current earnings and asset value. The negative PE reflects the unprofitability, and while that EV-adjusted EBITDA might not look crazy high in isolation...
You have to remember the adjustments baked into that EBITDA number.
Exactly. So these depressed multiples, yes, they could signal big upside if the turnaround works, but they equally reflect the very real risks and uncertainties the market sees. It's a classic show-me story.
How does Advantage compare to its peers on these metrics? It's tricky with the cost of being private now.
It is tricky, but we can look at others like Spar, maybe Inmar, or even the big marketing service firms like Publicis, Omnicom, IPG. Advantage's PS ratio is almost certainly at the extreme low end of any relevant peer group.
And the profitable ones trade much higher.
Right. Profitable peers, especially in marketing services, often have positive PE ratios, sometimes well into double digits. Advantage's EV-adjusted EBITDA, around 5.6x, needs careful comparison, accounting for how peers calculate EBITDA.
So the takeaway is it looks cheap on sales, but that's probably justified by the losses, the debt, the turnaround risks.
That seems to be the market's verdict, yes. A re-rating likely requires sustained proof of financial improvement, getting back to GAAP profitability, generating strong, consistent free cash flow. The market is waiting for tangible evidence.
Okay, what about trying to estimate intrinsic value? That sounds incredibly difficult here.
It's exceptionally challenging right now. A discounted cash flow, a DCF model, heavily reliant on future free cash flow projections, which are, frankly, anyone's guess at this stage, given the transformation.
An asset-based valuation.
Probably not meaningful given the negative tangible book value. Goodwill dominates. Earnings power value, also highly speculative, with the ongoing restructuring and no stable earnings base to normalize.
So intrinsic value is basically a bet on the turnaround succeeding.
Pretty much. Any estimate is hugely sensitive to if they execute successfully and return to sustainable profit and positive free cash flow. The range of outcomes is just too wide for a precise calculation right now. Investing here is fundamentally a belief that management can unlock value the market doesn't currently see or believe in.
What does the analyst community think? Are they seeing that potential value?
Interestingly, yes, much more so than the market price suggests. As of May 2025, the analyst consensus seems to be generally in the moderate buy to buy range.
And the price targets?
They're quite optimistic. The average targets range from about $2.60 up to $4.50.
That implies huge upside from $1.47.
It does. Anywhere from 77% to over 200% potential upside based on those analyst targets. Now, interestingly, they are still forecasting negative EPS for FY 2025, aligning with management's cautious outlook.
But they expect profits after that.
Yes, they anticipate a return to profitability later. Their revenue growth expectations for FY25 are low single digits, also matching company guidance.
So the buy ratings and high targets suggest analysts are pricing in a successful turnaround, while the market clearly isn't.
Exactly. It's a significant disconnect. It raises the question, is the market missing something big? Or are the analysts perhaps underestimating the execution risks and challenges?
That's the multi-million or maybe billion-dollar question here. Okay, let's shift to Chapter 5, ownership structure. We mentioned the governance aspect, but the shareholder base itself is key.
It is. And the dominant feature, as we discussed, is a private equity firm, Leonard Green and Partners, holding that majority stake, around 56%.
Which gives them huge influence.
Massive influence on strategy, the board, executive pay, major decisions like divestitures or acquisitions, and certainly that recent restructuring.
So understanding LGP's likely goals and timeline is crucial for any investor.
Absolutely. Their focus is typically on generating a strong return on their investment over a specific time frame, which might influence decisions differently than, say, a long-term individual investor's perspective.
And it seems this PE ownership, along with other institutions, might be feeling the heat from the stock's performance.
There were reports, back in April 2025, suggesting major institutional holders had seen the value of their advantage stakes drop by about 20%.
And institutional ownership is significant overall.
Around 32.4% is the estimate. So a substantial chunk of the shareholder base has seen significant value erosion recently. That kind of pressure can lead to increased engagement with management, maybe pushing harder for results.
Okay, let's move into the thick of it with Chapter 6, risk assessment. What could go wrong here? Let's start with business and operational risks.
Well, client concentration or loss is always a risk in this business. We saw that with the intentional resignation in branded services. Losing a key client could hurt significantly.
And the transformation itself.
Execution risk is huge. It's a complex plan with many moving parts. Failure to execute effectively is a major risk. Then there are ongoing operational challenges like labor costs and availability finding and retaining good people for that large field force.
Technology too.
Yes, integrating and leveraging technology effectively. Using their data analytics capabilities to provide real value. Falling behind technologically could be a big problem.
What about financial risks? We touched on many already.
Totalist. The high debt and leverage. That net leverage at 4.0x above their target. Sustained GAAP net losses that can't keep losing money indefinitely. The profitability pressures we saw, particularly on those GAAP engines. And the risk of further goodwill impairment, given the negative tangible book value.
So the balance sheet remains a significant vulnerability.
Definitely. It reduces their resilience to shocks and limits flexibility.
Okay, competitive risks. Market disruptions.
It's an intensely competitive field. Acosta is a major rival, even if private. plus others. Technological disruption is constant. Think e-commerce shifts, the rise of retail media, AI impacting marketing and sales. They also have to navigate shifting consumer behaviors and trends within the CPG industry itself.
They need to stay agile.
Very agile. And demonstrate a clear, differentiated value proposition.
And then there are the broader risks, regulatory, macroeconomic.
Sure, changes in regulations around labor, advertising, data privacy could impact them. An economic downturn would likely squeeze client budgets further. And as we all know now, unforeseen events like pandemics can have major disruptive effects.
And you mentioned earlier, these risks aren't isolated, they're interconnected.
Exactly. Failure in one area often makes things worse elsewhere. For example, poor execution of the transformation hurts financials, which makes them more vulnerable to competition or unable to invest. That client resignation impacts financials, but also raises questions about their competitive standing. And the high debt limits their ability to respond effectively to any of these threats or to seize new opportunities.
It's a complex web of risks.
It is. The high debt acts like an amplifier for all the other risks. Successful transformation is key to mitigating this interconnectedness.
Okay, let's specifically address the potential impact of those U.S. tariffs of 2025. How might they affect Advantage?
Well, the direct impact on Advantage itself, as a service provider, is likely minimal. They aren't importing goods subject to the tariffs directly.
Their clients are.
Exactly. The indirect impact via their CPG clients could be significant. A potential 10% global tariff, plus maybe steeper targeted ones, means higher costs for clients importing raw materials or finished goods.
Which could lead to budget cuts.
Potentially. Reduced marketing and sales budgets are a real possibility if client margins get squeezed. We could also see supply chain disruptions for clients, shifts in their product portfolios, maybe more focus on domestic sourcing.
What about the retailers?
Retailers might face higher wholesale prices from the CPGs. This could lead consumers to shift towards lower-priced alternatives, which, interestingly, could be an opportunity for Advantage's Damon private label business.
And potential upside amidst the uncertainty.
Possibly. But overall, the tariffs inject significant uncertainty for Advantage's clients. This uncertainty could translate into budget cuts for services perceived as discretionary.
So the risk is that Advantage's services get cut back.
That's the key risk. However, there's also an opportunity for Advantage to position itself as a partner to help clients navigate these tariff complexities. Maybe using their data analytics to track consumer responses to price changes, optimizing merchandising for new product flows or different sourcing, bolstering that private label support.
Yeah.
The key is demonstrating indispensable value in helping clients adapt, rather than being seen as just an expense.
Oh, okay. That makes sense. So that brings us to Chapter 7. Brief conclusion. Let's try and summarize.
All right. Advantage Solutions clearly has significant scale in its industry, and they have a defined turnaround strategy underway led by relatively new management. But they face really considerable financial challenges, ongoing gap losses, high debt operating in a very competitive market, which is now facing additional macroeconomic uncertainty from things like these potential tariffs.
That captures it pretty well. Scale and a plan, but significant hurdles and new headwinds.
Precisely. A substantial market presence and a roadmap for improvement. But the path to sustained profitability and a healthy balance sheet looks, well, challenging in a dynamic and complex environment.
So here's our final provocative thought for you, the listener, to chew on. Given this stark contrast, we've seen the deep analyst optimism versus the clear market skepticism reflected in that low stock price, and considering the huge transformation underway, plus the wild card of potential tariff impacts. What's the one single critical metric you would watch most closely? What would tell you if this potential deep value play is genuinely starting to turn the corner?
And related to that, what would your personal threshold be for that metric before you'd even consider making an investment in Advantage Solutions?
Food for thought.
And that leads us right into our end hook reveal. The sheer complexity of trying to value a company going through such a massive transformation, especially when you layer on external shocks, like potential tariffs rippling through their client base, it really highlights how difficult predicting the future is here.
Yeah, projecting future free cash flows in this kind of situation.
It's like trying to predict the exact ripples in a pond after you've thrown in not just one, but several stones at once. You need to understand the initial splashes, sure, but also all the cascading effects, the interactions, and the fundamental structure, the depth of the business underneath it all. It's incredibly complex.
A good analogy. Well, that brings us to the end of this deep dive into Advantage Solutions. We certainly hope this analysis has given you a much clearer picture of the company, its strengths, its significant challenges, and its potential opportunities.
And we absolutely encourage you to do your own thorough research. Consider everything we've discussed today, but always in the context of your own investment goals and your personal tolerance for risk.
If you found this analysis helpful, please do subscribe to the Stock Analytics AI YouTube channel. We'll have more deep dives and insightful discussions there. And remember, all the sources we use today are linked in the description.
And the necessary reminder, this deep dive is purely for informational purposes. It is definitely not financial advice. Any investment decisions you make should always be based on your own diligent research and a careful consideration of your unique financial situation. All the information presented reflects publicly available data as of our report date, May 10th, 2025.